In this week's podcast, following BT's shock profits warning earlier in the week, Nick Zieglash is going to go through those numbers in detail. I'm just going to step back with the Dow hitting 20,000 and some major policy coming through in the States to look at where we are in terms of equity markets. So the first point is that we feel that following a 35-year bull run for bonds, that the allocation towards bonds against equities is heavily skewed. That skew doesn't work in an inflationary world. So we've gone from a period where in 2016 there was an argument against inflation or deflation to a world where we think inflation is definitely coming through, and it's to the extent at which it comes through. And what Trump is doing and what we got confirmed this week is that lower taxes, higher spending, significant deregulation is simply going to accelerate that transference from deflation to reflation and inflation. That changes the dynamic between equities and bonds. And historically we've talked about the equity gilt yield, which is the relationship between the bond market and the equity market, with the equity market yielding half what the bond market yields. At the moment it's reverse of that, so the equity market yields twice the bond market. We feel that if that normal relationship, which should exist in an inflationary environment, reasserts itself, which it will over time, then you could have a significant re-rating of the equity market. What will raise rates and the risk-free rate will be inflation and the type of inflation that starts to come through. Where we are in the business cycle, we feel, is at a point where it is mature. We're 7 years in, we've got full employment, and we're starting to see wage inflation coming through quite strongly. If we look at where employment is, we're starting from a point at 4.8 in the States against a trough of 3.9 in 2000, a peak of 10% in 2009, and an average of 6 across that period since 1990. That there is scope for wage inflation to come through, but that doesn't necessarily mean that CPI or the general inflation basket that the Fed is worried about actually accelerates at the same time. And what we feel is that, as in the 1990s, there are structural changes in the economy which will keep CPI lower, while at the same time a stronger dollar will keep inflation lower within the US and allow the Fed not to raise rates too quickly and stay behind the curve of inflation. At the same time, as we saw in 2015 and 16, there will probably be issues because of protectionism in other parts of the world. So stronger dollar will probably mean more money coming back into the States. We're seeing some quite significant outflows in terms of capital coming out of the emerging markets, particularly China at the moment. And those issues in the emerging markets, potentially politically in Europe, are likely to mean that the interest rate differential between the US and the rest of the world is something that needs to be watched, and therefore the Fed won't be able to raise the risk-free rate too aggressively. As a result, we can see that as this inflationary pulse comes through markets and rates stay pegged at a fairly low level, then you could see a very positive impulse for the equity market more generally. That will transition itself more cleanly through the US economy, because that's the basis of which this argument is being made, but it will apply to the UK economy as well in terms of valuation. We feel that at the moment a lot of stocks in the UK economy are priced for a recession. We just don't see that happening. We're seeing stimulus in terms of fiscal and monetary. We've got a very weak currency, which is positive for growth in the UK, and we've also got full employment. So as the numbers here show from the UK PMI, we feel confident that those stocks that are priced for recession are incorrectly priced. Looking at the week ahead, we're in the midst of the reporting season, so there's a lot to talk about. Key for us will be Ocado on Tuesday, Apple, Harley-Davidson, Facebook on Wednesday, Thursday, Shell, Zeneca, Compass, Glencore, Vodafone, Merck, Visa, Amazon, Novo Nordisk, and that's it in terms of the Killik stocks. Thanks very much.
BT Group announced a profit warning this week, predominantly off the back of accounting irregularities uncovered in its Italian business, as well as some slowdown experienced in the UK public sector market. In the Italian business, a number of senior staff members have been suspended and a new CEO is in place. The Italian business has now moved into a loss situation, and the BT will be looking to structure the cost base to return that business to profitability. On the UK public sector side, there's been a slowdown in central government related contracts, and this hasn't been replaced as expected by regional local government contracts, and also the usual seasonal spending of budget in the fourth quarter hasn't materialised this year. Overall, our view on BT is that although this profit warning is disappointing, management was still very confident in terms of its businesses, such as the consumer business and the EE business, and they're still confident in their cash flow generation abilities, and are maintaining their target of a 10% per annum dividend growth rate. So we would use the weakness in the share price to continue to pick up stock in BT. Thanks so much.